Hey traders, a warm welcome to you. So as I mentioned earlier, if you are long the stock, you can actually then sell a call that is out of the money to take some premium from the stock. Now this gives you the dividends, gives you the voting rights, the ownership rights of the stock, but you're getting a little bit of premium back by selling the call. Now, the downside of course is that you cap your upside, because at a certain point when you get past that call, everything you gain in the stock you're losing on the downside of the call, because you're short the call, because the call is going up in sync basically with the value of the stock. But it's the downside as well. You've got unlimited loss, because even the call will expire worthless, which is good for you, which will limit the losses a little bit. Obviously the stock could go down and you've got unlimited loss, all to zero effectively for the stock. But that's no different to stock ownership. So you probably would have this based around a standard trading strategy with a stop loss in place for the stock anyway. But having the call potentially gives you a bit more premium and maybe limits the loss a little bit more. Anyways, look at a little bit of an idea and see how it might work. So let's say we are, this is how we would execute a cover call. We're long 100 shares and we sell one call, because one option contract, don't forget, is 100 shares. So we want to keep that equivalent. So for 200 shares, it's 2 contracts, etc. So let's say we are long 100 shares of XYZ at $50, okay? And that's cost us $5,000 for those shares. And let's also say that we decide to sell our out of the money call at $55, and it's costing us $2. That was priced at $2. And because we're selling it 100 shares at $2, we're receiving $200 for writing that call. The buyer's paid us the premium of 200, or $2 times the 100. We're receiving that. So the total outlay for this deal is the $5,000 for the shares, minus the 200 that we receive for the call, $4,800 in total. Okay, let's look and see what happens. So let's say it's good, the stock rallies, it rallies from 50 to 57. What happens to the value of the stock? Well, it goes up by $700. I've got 100 shares, $7. We've made $700 on that share. So $700 on the trade with the long stock side. But the call option, what happens with the call? Well, the call was at 55, right? But this is now in the money. So the buyer's going to exercise that and say, well, that's got $2 worth of value, 200 bucks. Yes, please, I will exercise that, which is fine. But don't forget, even though it's got $200 worth of value, he paid $200 for it. And you received $200. So it's actually a net of 0 on that. So you've made 700 bucks on the share price lift, and you've made nothing on the call. You're making 700, just exactly as you would be if you didn't have the call in the first place. So that's okay, that's an example there. What happens though if the stock price falls dramatically? So if it falls dramatically, this is what's going to happen. Let's say it falls to 43. So maybe not too dramatically, but $7 the other way. The stock price is going to be down 700 bucks, right? Down on that, because you're $700 down times the 100 shares. You're down on that deal, that side of the deal. Okay, the call option is going to be worth 0, because the buyer has the right but not the obligation to buy something at $55 that now is at $43. That's worthless. But that's good for you, because you've received all that $200 premium. So unfortunately you've lost $700 on the stock, but you've gained that back from the premium. So your net loss is only $500, which is much less percentage terms than the 700 bucks you would have had just by being the long the stock. So that's a good way for it. And you can see how that would work even lower. So basically you're taking $200 off your loss the lower and lower you go. Now, of course, the lower you go, the more you're going to lose on the stock. There's no protection on that unless you've got a stop loss in, but you can see you cushion it a little bit by receiving some of the premium from selling that call. Okay, let's have a look at the upside and let's see what happened to the upside and see the damage you potentially would get to the upside, or profit, should I say, the upside, and how it caps it. Now let's say this thing rockets to 70 bucks. If you're long the stock, you're seriously happy, you've gone from 50 to 70, $20, 100 shares, whoopee-doo, you've made $2,000. That's fantastic. But if you'd written this call, unfortunately, every kind of dollar above 55, the buyer's going to exercise it. So when it gets to 70, it's got $15 worth of intrinsic value, which is $1,500 when you factor in the price of the amount of shares with the option contract. So even though you've made $2,000, you've lost $1,500 on the call, but it's not quite $1,500. Don't forget you sold the call for $200, so in reality you're only losing $1,300 there, but still it's not quite as good, is it? Because you would have made $2,000, you've lost $1,300 there, your net is $700, and that's the same for however high you go, because whatever the stock goes up, the call is going to go up. You're still going to receive the $200 that you received for the deal, but you're going to have to pay out for the loss on the call. So you've capped it at $700 no matter how high you go, but you're getting something. If the stock price were to do nothing or go lower, you're getting something back. And actually that's probably the best scenario for you. The best scenario for you is that it creeps up to 55 and stops there, because then not only do you receive, in fact we'll do the sums here for us. Let's look at 55. What's the value of the stock at 55? We bought it at 50. It's got a $500 worth of value. That's great. What about the call option? Well, the call option is worthless at 55, right? It's worth zero. And that's good for us. We get the full premium into that. No one's going to exercise something at 55. 55's got no value. We've got the $200 back for that. So in this case, we're getting $700, which is $200 more than we would have done if we hadn't sold that call option. We'd have just received $500. So you can see that's the best case scenario for us, is it goes up to 55. We get a little bit of a boost from the stock. We also get a bit of a premium boost from selling that call option, and we keep the voting rights. We keep all the reasons that we had the shares perhaps in the first place. So it's a good, interesting strategy. Perhaps if we're all existing already long, we think it's maybe run out of puff a little bit, we could sell this call to get some premium, and we could keep doing this potentially. We could keep selling calls, collecting premium, collecting premium, collecting premium. Of course, the downside is that we do forego upside. If the stock suddenly rips off the upside and we're in it, but we've sold that call, we're effectively hedged off on anything above the level we sold the call at. So that's something to bear in mind. But if it goes down, we've made a little bit on the premium. If it stays where it is and just stagnates, that's the best case scenario. We've made all the premium and the stock's just sat where it is. All right, guys, that's cover calls. Interesting strategy. If you like this kind of stuff, thumbs up. See you next one. Take care. Bye-bye.